Welcome to the Real Vision Daily Briefing. It's Thursday, November 19th. I'm Jack Farley, joined shortly by managing editor Ed Harrison. But first, with today's stories, Haley Draznin.
Hi, Jack. Well, we saw markets mix Thursday. Both the Dow and the S&P 500 were down slightly at the time of this recording over renewed coronavirus fears. But the Nasdaq did find itself in the green. Notable moves higher were Shopify, Tesla, L Brands, which is the parent company of Victoria's Secret and Bath and Body Works, as well as the Nasdaq company. That rallied after they announced a deal to acquire Verafin, which is a software company specializing in preventing financial crimes. But overall, the broader equity market was down on the heels of the U.S. jobless claims report. These numbers are ugly. It's a warning. Another 742,000 Americans filed for state unemployment benefits last week. That's an increase of about 31,000 from the prior week. This is the first time in 5 weeks that we are seeing an increase. The data suggests the economic recovery is being threatened by a rise in COVID cases. The U.S. is in jeopardy, really, of recording a double-dip recession, similar to what we're seeing in Europe play out right now. It's really troubling, and likely indicative of what we're going to see in the next few weeks, as cases continue to soar again and new restrictions are put in place in cities and states across the country. This is worrying too, as we could see more layoffs coming. So overall, nearly 20 million Americans are currently on some form of unemployment aid. And then there's this red flag. 4.4 million Americans are receiving pandemic emergency unemployment compensation. This number is up from 1.4 million in August. That's the program for people who have been unemployed for months and exhausted their regular unemployment insurance. It is expected to end on December 26th. If Congress does not act, that's the day after Christmas. And Congress so far has failed to agree on any new stimulus package for jobless individuals and struggling businesses. So we really need to be prepared for what's to come. Back to you, Jack.
Thanks, Haley. Welcome, Ed.
Thanks, Jack. It's good to talk to you again.
Yeah, great to be here. So I read your newsletter today from Credit Write-Downs. It seems like you've got your eye on the virus as well as its economic impact. What are you seeing there?
Yeah, it's a bit of a doom and gloomer, I have to say. I hate to put negative information out, but I think that when it comes down to it, maybe 2 weeks ago, just over 2 weeks ago, I made a call saying that the shutdowns that we were seeing in Europe were going to lead to a double dip, and Europe is large enough economically that we could probably call that a global double dip. But the U.S. was still hanging on by a thread. It wasn't necessarily clear where the economy was going. But I think that now that we've seen that the coronavirus case counts have gone high enough to cause these sorts of rollbacks of the reopening and actually shutdowns in some cases, we can really start to think about a double dip in the United States as also being a base case for the end of this year and going into early next year.
Right. And just to read the data, I feel like we've been hearing and saying that the cases, the deaths, the hospitalizations have been rising. But just to give some numbers, 251,000 Americans have now died from coronavirus. Just yesterday, it was 1,923 people died, and 172,000 cases were recorded on Wednesday. And if you average it out, the percentage increase from 2 weeks ago is 77%. And you see looking at the same data that I am, and the increase in the cases. Last week I feel like it was about 68%, 70%. So it's not just that the cases and the hospitalizations are getting worse; it's that the rate at which they're getting worse is itself getting worse. So, what's your outlook for how this impacts economic activity going forward?
Yeah, that's a good point. And by the way, the one thing that we're missing there is the hospitalizations, because that's the real important thing. I think that you put the nail on the head is that it's not just that the numbers are going up, but they're going up at a faster rate. So when I talked about this, I said on credit write-downs that by Thanksgiving we should expect to get to 2,000 deaths per day, and we're already at 1923 now, a week ahead of time. So we're there before, and as you rightly say, both the case count increase over the last 2 weeks and the death count increase have accelerated. So I was basing my numbers on numbers that were lower than the numbers that we are now. So since we're accelerating and these things happen with a lag, we can pretty much assume that we're going to get to the levels that I was talking about, which are the levels that we had back in the spring. The key here for me is hospitalizations. That's the one that we're not talking about. I saw a MarketWatch report that said that we're almost at 80,000 hospitalizations across the United States. At the peak, both in terms of the first wave and the second wave, we went to 60,000. So now we're at 80,000. We're already ahead by 33% relative to where we were in those phases, and it's going higher at an accelerated rate. So the reason that there's a connection between the virus and the economy are shutdowns, and shutdowns happen either prematurely in order to prevent healthcare system overload, or after the fact, after the healthcare system already gets overloaded and you need to really shut it down. But once the healthcare system becomes overloaded, then policymakers are forced into action, and they have to shut things down, to roll back the reopening, and in worst case scenarios, just have a lockdown altogether. So given the numbers that we're seeing in the hospitalization rates and also the rate of increase, we are likely to see not just the shutdowns that we have now, the rollbacks, but even greater numbers going forward. And that's where the healthcare crisis moves into the economic crisis. That's where the two come together, is via this route of hospitalization, healthcare system overload leading to shutdowns, and therefore to worse economic outcomes. And I would say, if you look at the data today, the jobless claims data that came out today, that's the first inkling that we're already there. The jobless claims numbers went up in the order of 40,000 over the last week. This is the first rise that we've seen in 5 weeks. And I had anticipated that we would get to this level by early December. So again, the numbers are actually getting worse ahead of the levels that I was talking about 2 or 3 weeks ago. So the deterioration in the situation in the COVID-19 crisis is so acute that I think that these numbers are going to get much worse relative to what my expectations were. And that means that, we have to start thinking about the economy not just rolling over, but the economy actually contracting.
Right. And tell me, Ed, the importance of Thanksgiving and holiday season in general. I feel like normally that's the time when people, ask for time off from work, they take vacation, and they, order a lot of things either from Amazon or in a physical store. How is the pandemic going to affect that whole dynamic, as Thanksgiving approaches so soon?
Yeah, so I think the way to think about it is the lag between case counts, then hospitalizations and deaths, and then shutdowns, with hospitalizations being the real key component. What we're going to see with the Thanksgiving period is a period where, according to the CDC, which has said do not travel for Thanksgiving, and 7 governors who have also said don't travel for Thanksgiving, we're going to see a lot of infections, because what the CDC is saying is that actually a lot of the infections are happening now in small groups. It's like when you have a football party or when you have a small gathering at your house, especially indoors because of the cold weather outside. That's now, instead of these super spreader events that are large, this is where the spreading happens with people who are close to you, family and friends. Thanksgiving is going to be a perfect example of that. And so to the degree that people are going to flout these recommendations, and I think that they will, we're going to see a big increase in the cases, and with a lag, the hospitalizations and the deaths. And that lag being, say, 2 to 3 weeks in terms of hospitalizations, in terms of the healthcare system overload, where we're at 80,000 that are hospitalized now, that number is going to go much higher in the beginning of December and mid-December. So by the time we hit Christmas and New Year's, it's going to be a much worse situation than it is right now.
Right. So the pandemic and the fact that it's worsening, that is going to depress economic activity either through people just not going out more because they themselves are scared, or by government fiat. So that's one thing. And I want to talk to you about how that's going to impact markets. But there's another thing that I know is on your radar, and that is the fiscal aid. Not just the fact that it's unlikely we won't get another fiscal stimulus for a while, but the fact that the ongoing efforts are going to expire soon. What can you tell me about that?
Yeah, so I think that, when we're thinking about the economy rolling over, that's growth rolling over. So growth going from, say, 2% to 1.5%, or 2% to 1%. There's the growth rolling over to actual outright contraction, and usually you need an impetus, either a massive increase in jobless claims, as an example, or jobless claims increasing, and then you add on another sort of component of money being sucked out of the economy. This is where the fiscal measures come into play. So there are two things to watch for. One is the fiscal cliff associated with a potential government shutdown. And I think that the date for that is December the 11th, that if the government doesn't come up with a budget to get over the impasse between Republicans and Democrats, then we're going to have a shutdown of the government. And we've had those before, lasting as much as a month, and that's going to be negative for the economy. The second thing is the CARES Act thought that by this time we might be through the worst of it, and as a result, a lot of the things associated with the CARES Act expire. There are two dates there, December 26th and also December 31st. The 26th is when pandemic assistance for many people lapses entirely. Not just some people, every single person who is getting pandemic assistance will be kicked off the rolls as of December the 26th. Also, starting at the end of the year, you'll be able to evict people from their homes if they're past due. So all of these three things are coming due within the next 5 weeks, and those happening at the exact same time that I'm anticipating a mushrooming of the hospital overload cases. That is the number of states where you do have a hospital overload. Those two will combine into a very pernicious brew, which I think means it's not just rolling over of the economy, but outright contraction. And let me just say, in the past, when I've looked at the numbers for jobless claims, usually it's a persistent increase of 50,000 or more over a certain period of time that triggers a recession. Every single time that jobless claims have jumped up over a discrete period of time, usually it's a year or 6 months, but here it's happening very abruptly. That's enough of a shock to personal income that it triggers recession. And so the levels of increase that we see now already, if that continues on some level and maintains itself, then we would have that sort of income shock.
Yes, a pernicious brew indeed. As you say, we've got the pandemic, we've got the fiscal, the CARES Act expiring soon, the prospect of a government shutdown. That's three you mentioned. I might add many of the Federal Reserve's specialty programs that they launched in March and April are set to expire on December 31st. I think actually eight out of the 9 programs are set to expire on the 31st. Now, it's not as big of a risk because the Fed is not a super democratic institution, so it doesn't. There's no gridlock, and they probably will roll it over. But we have these looming threats. So this is the world that you and I are witnessing. But the market perhaps is witnessing a different world because the S&P is hovering around all-time highs. Bond markets are, well, actually, rates are low in the bond market. The VIX is at 21, the lowest level in many months. Let's consider the counter argument. What do you think the people who are, let's say, shorting the VIX and buying equities? What are they saying?
I think they're saying that the Fed will ride to the rescue. That there's a lot of liquidity that's baked in there, and that in worst case scenarios, actually, if fiscal is not happening, then you're going to get a monetary offset. So if the level of fiscal that's needed is here, and you get this level of fiscal, then if the level of monetary support that equates to that fiscal that you would normally get is here, then you're going to get this much. So there's that offset between those two. And the amount of offset that you need to have from a monetary perspective is gargantuan compared to what you would get on the fiscal side. So it's an absolute torrent of money that could potentially get into the markets. We're talking about not just quantitative easing, but qualitative easing moving into individual names in the investment grade credit market, going into junk bond ETFs, and then potentially taking further action in order to stave off any sort of liquidity problems that you would have. I mean, my biggest worry is that you will have liquidity problems for individual companies, that the sectors that are going to be hit the hardest, and especially small businesses who won't be getting as much of the Fed's liquidity, they're going to go to the wall. And that's going to cause an unemployment crisis where those jobless claims are going to go up above that magic 50,000 level and stay there for enough time that you're going to get a recession. But it doesn't necessarily mean that that markets are going to go down, because the stock market's not the economy, as people always say. I thought it was interesting to talk to Michael Howe. I still am thinking about the things that he said, saying that the numbers in terms of the actual monetary response in 2020 have not been met by the numbers in terms of the market response. That there's still more upside for the market based upon the existing liquidity that's been injected into the system, and yet we still have the potential for more liquidity. So I think that's what we could say. Let me just tell you also in terms of where markets were today that I thought was interesting. So you had the 10-year at 85 basis points. That's relatively high. That doesn't show to me any sort of, even in the bond market, you think of the bond market as a canary in the coal mine, or even junk bonds. There's nothing in terms of the spreads there that's saying that bad things are going to happen. You saw a WTI at $42, over 42. There's nothing there that says bad things are going to happen. And at the same time, you have the equity prices. I across my screen, I didn't see any sort of major moves in equities. And then the thing that I found the most interesting of all of this, the last thing, is the dollar index and euro dollar, EUR, USD, because, and I spoke to Tom Thornton about this yesterday. The DXY is at the lowest levels that we've seen since we had this crisis. It dipped once before to about the levels where we are now, and it's back to those levels. And the euro is breaking out almost to the 119 level. Those are numbers that don't suggest stress, because usually what happens when there's a stressful event, there's a flight to liquidity. There has been a flight to the yen already thus far, but there hasn't been this flight to the US dollar. The US dollar is weak. It's at the weakest part of the range that we've been range bound in since the pandemic began. Tommy Thornton was telling me, however, that DeMark indicators that he's looking at suggest that we're at the bottom of that range, and that he sees a move back. So to the degree that the yen move and now potentially the dollar move are presaging some sort of stress, people, a flight to quality, maybe that's something to look at. But none of the numbers that I'm seeing thus far suggest that the problems that you have in the real economy are spilling over into the financial economy. And before I forget, let me also just add that I think I told you offline that in Europe, there's also similar problems in terms of gridlock. And this happens because of Hungary and Poland are at loggerheads with the rest of the EU about their ability to have political discourse. That potentially they're going towards a more authoritarian regime, and they're not going to disperse funds unless these guys say that we're going to roll back any of these more authoritarian types of measures. And so Hungary and Poland have vetoed the aid from the EU, which is in the order of trillions of dollars trillions of euros of aid.
Wow, that's really interesting about Hungary and Poland. I've just got the Euro USD EUR on my screen, and I am seeing what you're saying in terms of what Tommy Thornton said. It also makes me think of Russell Napier a week ago said that the many currency euro, like the US dollar, had about four versions of it. There was the continental currency, which went bankrupt, the greenbacks, which had problems, and then ultimately was the dollar. So he thinks that the euro is essentially a doomed currency. It also makes me think of the people, sort of the dollar milkshake crowd, who think of all these emerging market countries that have debt that's denominated in dollars, and that if the dollar goes up, that will just suck all of that liquidity into the countries, which will be very good for the dollar. I think that argument is a very compelling one. I will say to the people at home who think, oh, the dollar's going to go up because of the emerging market thing, I'm going to buy the DXY. Just remember, the DXY is consisted mainly of the euro and the yen. So there are not a lot of emerging markets currencies in there. Interesting, Ed, I don't know what your framework is on this, but Turkey did a major raise of its rates. Its current account has been in shambles and deteriorating over the past years. And finally, they raised rates, which is what the international community has been calling for. Do you have any views on rates either in the U.S. or in Euro or in the European Union or emerging markets generally?
Yeah, I have some thoughts on that. But even before I get there, let me tell you, because I was looking earlier today at the chart for DXY, and I thought it was interesting if you sort of subdivide it into various periods of time over the last year. There was a period where it was floating around 98 right up until the crisis, and then it went way down to below the 95 level, and then spiked up dramatically well above 100 all in one fell swoop. I mean, this is the essence of the liquidity crisis. So there was no no hint that this was going on before it actually happened. It was very abrupt down and then up. Then we had sort of a level where we stayed during the lockdown, which was around 100. It dropped precipitously to a new level, stayed there for a little while the reopening was happening. And then towards the middle of the summer, it's been in this lull between, say, 94 and 92, where it's been now. So we're at a level now that we haven't been in the entire period before the crisis. So before the crisis, we were at a higher level. We peaked up, we went back down, and now we're at this level that's lower than where we were before. So I think that's very interesting in terms of thinking about what could potentially happen. In terms of, I think that, there's some binary outcomes there in terms of falling below the levels where we are now abruptly, or spiking up fairly abruptly. And that would be where you would have the problems with the emerging markets. With regard to rates, the thing that I find most interesting is the Chinese finance ministry going out and actually going in euros at a negative rate. I got a direct message from Stephanie Kelton, who's a MMTer. She was asking me what the hell is going on there. I mean, the Chinese are basically taking on liabilities in foreign currency, which anyone will tell you, especially in the MMT crowd, that you don't want to do. I mean, if you're a sovereign, the way that you protect your sovereignty is by issuing liabilities in a currency that you can print ad infinitum. But basically, with there's so much demand for bonds. Get this: the Chinese 5-year issue in euro, they wanted 4 billion euros. They got 18 billion of offer for a bond that had a minus 0.15% coupon on it. So 15 basis points below zero. So a negative yielding asset from the Chinese finance ministry in euros. That's what people are buying these days. So that tells you that people are starved for yield, because the yields are so low in Europe right now. They're willing to buy money from the Chinese 4.5 times oversubscribed. I just find it absolutely astounding.
Yeah, that is wild. You sent me that story maybe 20 minutes before this. It bamboozled me. I looked up the issue. I think I found it on Bloomberg. We can put it on screen. So it's a zero coupon bond, meaning there's no interest at all. The only the interest rate is paid when the principal is paid back. So generally, because interest rates are positive, it would be sold below $100 because $100 is par. But the bond was bought at 100.7, and I think it's now trading at 100.9. So we do have some negative yields. Ed, I'm curious, is this the first bond that is sold at a negative interest rate outside of the European Union?
I don't know if the Japanese have sold in their own currency, but I think that the combination of it is sold with a zero coupon, meaning that the duration of the bond is the duration of when you get your interest payment back. It's basically, yeah, as you said, zero coupon bond. So maximum duration, and the fact that it's a foreign issuer. It's a other government issuer. They can't create euros. I think that those two are very interesting facets to this. It's just a facet to how this whole thing is shaping out. I don't have a view as to what that says, but it's another sign that markets are awash in liquidity. People are desperate for yield. They'll do anything until the shit hits the fan, and at that point, then they're going to run for cover. But we're not anywhere close to that at this point in time.
Yeah, it makes me think. I'm just going through an interview which Kyle Bass did with Steve Clapham. It's going to air next Tuesday. And Steve Clapham did a deep dive on these 5 Chinese tech stocks, including Alibaba and Tencent. And Kyle Bass basically makes the argument that U.S. investors who own Chinese stocks, they own U.S. depository receipts. Which, if things end up badly with the U.S. and China, maybe they won't end up owning that. So I think Kyle's argument there is not one that's held by many people, but it's something to consider when you think of Europeans buying bonds priced in their own currency from China that have negative rates. It really is remarkable.
Yeah, you'd be loath to think that the Chinese would renege on those promises, but at the end of the day, we're living in a brave new world. It's the world of Real Vision Crypto, and I think that's why Real Vision Crypto exists. By the way,
definitely, the phrase "brave new world" makes me think of paradigm shift, which perhaps we can explore in a minute. But because you mentioned Bitcoin, that asset is now trading over $18,000. I have the price in front of me right now. What do you make of that, both from a technology standpoint as well as thinking of Bitcoin as a macro asset?
Yeah, I think that, here's how I'm thinking about it in terms of Real Vision. This is just purely from a Real Vision's perspective. I think that there are multiple things that are happening that are going on now that you can call paradigm shifts in terms of, this pandemic, where people are living, where they're vacationing, how intensive monetary policy is being used, things of that nature. And of course, cryptocurrencies, digital assets fit into that very nicely. For me, part of the paradigm shift from where Real Vision stands is that we've been somewhat early to the game in terms of thinking of the crypto space as something to look at. I think that most people who are in that space are much more avant-garde. They're fringier than the mainstream, and so the mainstream doesn't want to wade into that pool, or hasn't wanted to wade into that pool for that reason. There's a lot of volatility in cryptocurrency assets. The last time I was talking to Tommy Thornton yesterday about this, we were getting the dates wrong in terms of, where it topped out at 18,000 in 2017. Was it 2017, 18? It was actually the end of 2017, December of 2017. Then it fell off a cliff. However, now we're hearing Stan Druckenmiller. We're hearing about Paul Tudor Jones getting involved. We're hearing Jack Dorsey's Square putting 1% of their assets into the crypto space. All of these things are saying that we're now on the precipice of a a space which is going mainstream, if you will, because you don't see this institutional money entering into the picture unless there's a mainstreaming of the asset space. So I think it's a really exciting time to be involved and to be thinking about it. I don't have a view as to whether it is a store of value that's superior or inferior to gold, or whether Bitcoin or other alternative cryptos are better. But I just think that we're in a brave new world, and crypto is a big part of that.
Definitely. I feel like there's an attractive backdrop of the reasons you mentioned of technology. People are Jack Dorsey, Stan Druckenmiller, Paul Tudor Jones, and actually Hugh Hendry. You know, Raoul asked Hugh Hendry in his interview on Tuesday, what do you think of Bitcoin? And Hugh said, I'm a little bit skeptical, but hey, if it's good enough for Paul Tudor Jones, it's good enough for Hugh Hendry. And, people's names, people, well-respected investors, that carries weight. And companies like PayPal going into that space, that carries weight. I think I was watching Jim Cramer the other day, and someone asked him about Bitcoin. He says, I don't hate it. Maybe I think I'd probably buy PayPal because they're invested. So, I feel like Jim Cramer in 2016 the producer wouldn't have even taken the call,
Right. Yeah.
So we definitely are on the cutting edge. And I think and this is my own personal belief, I think Bitcoin is a compelling macro addict. I'm definitely not into it as much as, say, Raoul or Ash or Sebastian. But that's my subjective. But I think it's very interesting. I kind of feel like the central banks are just putting a lot of butter in the pan. And I think that there's a lot of liquidity sloshing around. And I mean, how much more can Apple go up? How much more do you think, is the value rotation going to continue? I think there's a lot of potential there. That's my own personal view. But on an objective front, I think that Real Vision Crypto, which officially launched yesterday, is the place to be for crypto investors as well as entrepreneurs and just people who want to learn more about the space. There are a few podcasts sort of littered about, but I think in terms of being a mainstream video brand, I mean, I think we kind of are the only game in town. I don't know about you.
No, yeah. I mean, and that you want to own that space before everyone else is in that space. I have two questions on that front for you. I have a question, and then I also have a comment. Let me make the comment first, because it goes back to what I was talking about before in terms of the monetary offset. So let's just say that bad things happen in the economy, and you feel that the government is going to intervene in some capacity. If they do, the optimal intervention would be of this ilk, with fiscal policy here and monetary policy here. To the degree that fiscal policy doesn't compensate, it goes down this much. Monetary policy has to overcompensate going up this, but not just a little bit, but a lot more. They're going to turn it on. And so this is where Bitcoin comes into play. So this is what I'm telling you, I think is going to happen. This is what is happening right now. That is why, Bitcoin is an interesting thing. So that's my observation, number one. This question I wanted to ask you had to do with Hugh Hendry and the title of that piece. We're not in Kansas anymore. I was thinking about Tokyo. What is the Toto and Dorothy?
Yeah.
What was he talking about?
Well, Hugh, the yield curve, and it's generally upward sloping. It's a lot lower than it was a year ago, and a year ago was a lot lower than it was 19 years ago. Generally, the trend over the past 40 years has been rates have gone down. That's been a very, very good trade, especially if you use leverage. Hugh, there's a problem though with that, which is that short-term rates are the yield curve is not steep. Because the Fed has injected all this liquidity by buying long and 20+ year treasuries. That has made the yield curve relatively flat, and as a result, it's not profitable for banks. So that's why banks don't lend. The Federal Reserve can pump in all of this liquidity to banks, but the banks can just hold on to it. They're trapped. It's sort of like they're trapped in amber. So Hugh just wants to shock that system by just taking the yield curve and just sinking it. well below, not just to negative 50 basis points. He actually thinks that's pretty quaint. He says, no, I want it rates as low as negative 3%, maybe negative 5%. So it's just people who are, retirees who have cash. They say, no, you have to put it to productive use. It can't just hold it in your vault. And if you do, I'm going to take 5% every year. And yeah, the reason not in Kansas anymore, Hugh is quite fond of the Wizard of Oz, and he frequently refers to the Fed as the magician behind the curtain, or the man behind the curtain, and that everyone thinks it has all this power, but the power is sort of because we believe it has power. Sure, it can pump all this liquidity into the system. It can lend money to banks, but it can't force banks to lend into the real economy.
Right. Yeah, and I'll have to take a look at that in its full context, because I was there before the actual interview. I remember saying that I'd like to see the two of them to get together, and I haven't had a chance to watch it. But I will say that if you talk about that in the context of what Bill Campbell told me about digital currencies, digital central bank money, those two come into the fold in a very interesting way. And I think, just going back to our conversation about Bitcoin from that perspective, that gives you more impetus to the degree that government doesn't confiscate your money for cryptocurrencies that are not state sponsored. Very interesting stuff, I have to say.
Yeah, super interesting. Ed, I was really looking forward to this conversation between the two of us. I wasn't expecting us to talk about Bitcoin so much. It kind of just came out of nowhere. I wouldn't have thought that we would have had so much to say, given that we are not officially on the crypto team. I sort of book interviews, you conduct the interviews, and the vast majority of them are not on Bitcoin, whereas Ash is mostly focused on Bitcoin now. So it's kind of like we're like we don't play basketball professionally, but we play on the weekends.
Yes, definitely. Well, good. Jack, let's make this a once a week occurrence. Next week, I understand you've got Mr. Tyler Neville to talk to at some point in the week. Is that right?
Yes, I'll be talking to Tyler Neville on Monday, and he's got a very hard view on credit. He's very bullish, and I have to admit, over the past 2 months, he's been right. So I'm gonna do my homework over the weekend. So that's on Monday, and then you and I are filming an AMA on Tuesday for RVDB that airs on Thanksgiving Day. And I posted a question in the exchange, like, what do you want to ask Ed and me? And there's some really good questions. So I'm looking forward to that as well.
Good.
Yeah.
Excellent, Jack. So until Tuesday / Thursday, I'll see you then.
Yeah, great. Thanks so much, Ed.